If you take a traditional equity trading strategy and apply it directly to commodity markets, you will take structural losses. An equity share represents fractional ownership of a corporation. It has an infinite lifespan. Once you buy a share of stock, you can hold it indefinitely as the company operates. Commodity futures do not represent ownership in a company. They are standardized, temporary agreements tied directly to the physical delivery of raw materials. These raw materials are traded across 4 distinct venues: spot markets, options markets, contracts for difference, and futures. The bulk of this global pricing happens on major exchanges, specifically the CME Group, which houses the Chicago Board of Trade, NYMEX, and COMEX. These major exchanges act as central clearinghouses. They provide the deep liquidity and strict contract standardization required to trade millions of tons of grains, energies, and metals every single day. Treating a barrel of crude oil like a share of a tech stock ignores the physical supply chain. In these markets, that physical reality is the only true driver of price action. The most critical mechanical difference in futures trading is that it operates in a zero-sum environment. For every long position established, there must be a corresponding short position. Every buyer requires a seller. The total number of these outstanding matched contracts currently held by market participants is recorded as open interest. Because these contracts represent actual physical goods, they carry strict calendar risk. Unlike stocks, futures have fixed, non-negotiable expiration dates. The most important deadline on that calendar is First Notice Day, or FND. This is the moment the theoretical market collides with the physical world. Holding a speculative position into First Notice Day triggers physical delivery obligations. You are suddenly required to take possession of the actual commodity or face immediate, forced liquidation by your broker. To avoid this, speculators execute a maneuver called rolling. They close their expiring contract and open a new position in a further out month, completing this sequence well before the FND deadline. A commodity trader's survival is dictated entirely by these physical delivery schedules. Calendar management is the first mandatory line of defense against liquidation. Structural price movements in these markets do not happen randomly. They are initiated by specific fundamental catalysts, massive macroeconomic data drops that inject liquidity into the order book. The practice of tracking physical supply began exactly 150 years ago. In 1863, during the Civil War, Abraham Lincoln established the USDA to publish monthly statistical reports on crop conditions. Over a century later, massive informational blind spots allowed foreign buyers to quietly secure heavily subsidized U.S. grain. In response, the USDA created the World Agricultural Supply and Demand Estimates, or WASDE report. Released monthly, WASDE dictates agricultural market flow. By tracking global crop yields, weather impacts, and export demand, it sets the pricing baseline for domestic supply. The energy sector relies on a similar scheduled catalyst. Every Wednesday, the Energy Information Administration releases its weekly petroleum status report. This report details exact changes in U.S. crude oil inventories. A draw signals tightening supply, while a build indicates oversupply. The public release acts as an immediate, massive shockwave to energy futures. These government reports moves markets so violently that the agencies require strict physical lockup environments for their analysts, preventing any premature leaks of the data. Because the release schedules are public, these specific data drops dictate exactly when institutional liquidity floods the market to reprice the asset. Technical breakouts occurring outside of these windows are highly suspect. Without the macroeconomic fuel provided by these reports, the price action lacks the volume necessary for follow-through. To see exactly how institutions position themselves around these catalysts, traders look to the Commitment of Traders, or COT report. The most critical data point in this report is the commercials category. This group includes the actual producers, processors, and refiners of the raw commodities. These entities are the smart money. They know the seasonal realities of their products better than anyone, and they trade strictly to hedge their physical risk, not to speculate. Because of the massive size of the contracts they trade, they cannot enter the market at a single price. Instead, they scale into positions, routinely buying into downtrends and selling into uptrends. This physical hedging dictates the shape of the forward curve, a line graph mapping future supply and demand pricing over time. When physical supply is tight, it creates a downward sloping curve. This state is known as backwardation. Because spot price is higher than future prices, traders holding long positions capture a positive roll yield. Backwardation acts as a structural tailwind. Trend-following strategies benefit from riding this momentum upward as tight inventories apply buying pressure. When the market is oversupplied, the exact opposite happens. The curve flips into contango, creating an upward-sloping price curve where future prices are higher than the spot price. This generates a negative roll yield. The cost to store excess supply is priced into the deferred contracts, creating a relentless structural headwind for anyone attempting to hold a long position. Fighting the forward curve is fighting the physical physics of the market. Smart money aligns with term structure before they ever look at a price chart. Once macro fundamentals and term structure are aligned, execution shifts entirely to the intraday tape. But in a zero-sum environment, price action alone is deceptive. An upward tick in price does not distinguish between aggressive new buyers entering the market and trapped short sellers scrambling to exit. This table shows the volume and open interest matrix. It acts as the definitive lie detector test for market momentum by mapping price against actual participation. Look at the first row. When price is rising, volume is rising, and open interest is rising. This indicates a strong bullish trend. The rising open interest proves that new buyers are actively entering the market and establishing new long positions to drive the price higher. Contrast that with the second row. Price is still rising, but volume and open interest are actively falling. This is a weakening bullish trend. The rally is being driven purely by short covering. Existing short sellers are buying to close their positions, which drains open interest. The momentum is artificial and highly vulnerable to a sharp reversal. Open interest is the ultimate truth teller. If price breaks out but open interest drops, the move lacks the backing of new capital. It is a trap designed to liquidate retail traders. Even with fundamental alignment and a confirmed tape, the timing of your execution dictates your success. Professional execution focuses exclusively on high-liquidity primary sessions. Overnight electronic trading windows are notoriously illiquid. A single large order can easily sweep the order book, resulting in exaggerated, unsupported price spikes. When the U.S. morning session officially opens and Wall Street wakes up, the floodgate bursts open and institutional liquidity returns. Because of this sudden rush of volume, those exaggerated overnight price gaps frequently and rapidly retrace to their origin point during the morning open. To navigate this volatility, traders apply a volume profile to map these liquidity nodes horizontally across the price chart. This creates a precise tactical map. You execute entry orders near the heavy congestion of high-volume nodes and place stop losses safely beyond the empty space of low-volume nodes. Navigating commodity markets requires synthesizing three entirely distinct data streams into one coherent view. Professional commodity traders do not trade arbitrary shapes on a screen. They align with the forward curve, wait for macroeconomic catalysts, track commercial scaling, and execute only when volume and open interest confirm the tape.